Welcome to Let Me Fix This. Enjoy the video.
In this video, I will explain how to properly value a stock. First, thoroughly understand the company's business model and the industry it operates within. Next, dive into its financial statements, including the income statement and balance sheet, to grasp its financial health. Finally, identify and analyze key metrics like revenue growth, profit margins, and return on equity to gauge performance. This foundational work is crucial for accurate valuation. Once you have a solid understanding, explore various valuation methods. The discounted cash flow, or DCF, model helps estimate a stock's intrinsic value by projecting future cash flows. Also, compare the company's price-to-earnings, or P/E, ratio against its industry peers to see if it's over or undervalued. For companies paying dividends, the dividend discount model can be a very useful tool. Beyond the numbers, assess the company's overall financial health. Look at its debt levels and how effectively it generates cash flow. Evaluate the quality of its management team and any sustainable competitive advantages it possesses, like a strong brand or unique technology. Finally, project future earnings and revenue growth rates to anticipate potential returns. These qualitative factors are just as important as quantitative ones. After all your analysis, determine a fair value range for the stock and establish a margin of safety before investing. Always consider qualitative factors, such as brand strength, innovation, and customer loyalty, as these can significantly impact long-term performance. Remember to check the description for a link to the Owala water bottle and other great deals. Making informed decisions requires a comprehensive approach, combining both quantitative and qualitative insights for successful investing.
Thanks for watching. If you found this helpful, don't forget to like and subscribe.